Bismillahirrahmanirrahim. This video is about the balance sheet analysis of the four main players of an economy, i.e. the government, the central bank, the commercial bank, and the non-banking private sector, i.e. the firms and non-banking financial institutions. So we will look at each one of them in detail. So let's start first with the simplified balance sheet of the government. So like all balance sheets, the balance sheet of the government has assets and liabilities. So on the asset side, we have, for example, the deposits at the central bank and deposits at the commercial banks in the country. So we label them as 1, 2, and 3 for easier navigation. So let's look at each one of these. The first one is the deposits at the central bank. So this is the money the government keeps at the central bank. Number 2 is the money the government keeps at various commercial banks in the country. These deposits are classified as financial asset for the government, and correspondingly they are liabilities for the central bank and commercial banks respectively. So the point to understand is that every financial asset is a financial liability for another entity in the economy. So the financial asset of the government, for example, this money is a liability of the central bank. So this money is appearing as an asset for the government. So this deposit would appear as a liability in the balance sheet of the central bank. Similarly, this deposit is appearing as an asset for the government. However, in the balance sheet of the commercial banks, it would appear as a liability. So every financial asset has two sides. So every financial asset of an entity is a financial liability for another entity in the economy. So this is an important point we need to understand the modern macroeconomics. So on the liability side, we have the government bonds. These are the liabilities of the government representing debt obligations issued by the government. So typically governments issue short-term and long-term bonds, and these appear on the liability side of the government. Again, government bonds are financial liabilities. So financial assets and financial liabilities have two sides. So the financial liability, i.e. the government bonds, is a liability for the government. However, for the investors, this is an asset. So a government bond, a T-bond, a treasury bill is an investment. So for example, if the private sector buys a bond, it would record it on the asset side of their balance sheet. So that's an important concept we need to know. The double entry bookkeeping system. An asset, a financial asset, is a financial liability for another entity in the economy. So think of these deposits of the government like money, which we have in our current accounts. So the government uses these deposits for various purposes like transfer payments to the unemployed, for example, if they could invest the money in the infrastructure projects, they could purchase various goods and services in the economy. So this is just like money in the current account, which is used for the purchase of goods and services. So let us now look at the simplified balance sheet of a central bank. And I would just like to remind that what we're looking at is a very simplified balance sheet for illustrative purposes only. However, the actual balance sheet of a central bank is quite complex. But here the idea is to convey the main concepts and develop an intuitive understanding of different balance sheets of various economic sectors in the economy. So let's start with the assets. So on the asset side, we have government securities and bonds. We have private sector securities. We have foreign exchange reserves. And on the liability side, we have the government deposits, the reserves of the commercial banks, and the currencies in circulation. So first of all, looking at the bonds. So these are the short-term and long-term government bonds, and these are the assets held by a central bank, and they represent loans made to the government. So as I mentioned, the assets of an entity are the liabilities of another entity. So the financial asset, which is the government bond, is an asset for the central bank. However, it is a liability for the government, as we saw in the previous slide. Next, we have private sector securities. So sometimes central banks also purchase non-performing assets, i.e. bad loans or non-performing loans from the commercial banks to salvage the financial sector or to protect the banks from collapsing. So they buy some of those bad assets and record it on their balance sheet. So this is also an asset which is recorded on the balance sheet of a central bank. Third, we have foreign exchange reserves. These are the holdings of foreign currencies, and these are used for managing the exchange rate and providing liquidity in foreign currencies. So we've assumed in this example that the foreign reserves are zero. On the liability side, we have the government deposits, and as we saw in the previous slide, government deposits are like a current account. So this is the money which the government holds at the central bank, and the government can withdraw this money or use this money to transfer it to any supplier or to any citizen of the economy as transfer payment. So this is like the current account, and the government can use it to pay various economic agents. Next, we have the reserves of the commercial banks. So the commercial banks deposit some reserves at the central bank, and these are used for interbank settlements. And again, this is like a current account at the central bank. So the commercial banks in the economy would deposit certain reserves at the central bank, and for those commercial banks, these reserves will be in assets. However, for the central bank, these reserves are liabilities, and these have to be paid on demand. So the commercial banks can request the central bank to either settle this, transfer this to another bank, or to give cash, bills and notes and coins of $100 or £100. So these are on demand. This is like a current account or a checking account at the central bank. And finally, we have the currency in circulation. So these are the notes and coins which are issued by the central bank, and these are held by public and non-bank institutions. And these are liabilities also. So the currency in circulation represents a promise by the central bank to pay the bearer the value of the note or coin. So a couple of points to observe here is that the first is the central bank is an institution of the state. The central bank is fundamentally a part of the government, and its actions are oriented towards national interests, towards economic stability and growth, towards maintaining inflation, towards managing the interest rates, exchange rates, and so on. So central banks are actually part of the government. So now let's move on to the balance sheet of a commercial bank. So we've looked at the balance sheets of government and the central banks already. We are moving on to the balance sheet of a commercial bank. So as usual, we have assets and liabilities. So first component is the reserves at the central bank. So these are the assets of the commercial bank. Second is the government bonds and securities. The third asset is the loans which the banks have provided to customers. And then there are some other assets which banks hold. On the liability side, we have deposits from customers, we have short-term borrowings, we have long-term debt, other liabilities, and equity capital. So let's have a look at each one of them. The first is the reserves at the central bank. These are the funds, this is the money which commercial bank has deposited with the central bank. And this money is like a current account at the central bank. So these reserves can be used to settle interbank transactions. So if there is a debt of this bank on another bank, these reserves can be used to make the settlements. And these are very crucial for daily operational liquidity. They are considered as assets for commercial banks, but they are liabilities for the central bank, as we saw in the previous slide. So they will be on the liability side. Next, we have the government securities. These are the short-term and long-term bonds, and these are highly liquid assets. The third is the loans to customers. This is the core business of the bank. So any loans which the bank has provided to either individuals or businesses, they appear on the asset side of the balance sheet. Next, the bank could also have other assets such as property. They could have foreign exchange reserves as currencies, and so on. So there could be other assets as well in addition to the three assets mentioned above. So moving on to the liability side, we have deposits from customers, and these are the primary liabilities representing money the bank holds for customers. So this is typically the current account. So this is the checking account which customers use to draw checks or make debit transactions or transfer money from one account to another, to make payments to the sellers and the vendors. So this is the checking account which we as customers use, and this appears as liabilities on the balance sheet of the commercial bank. And these are the liabilities of the bank. However, they are assets for us because we use them for settling transactions. Next, we have short-term borrowings. These could be like interbank loans on a very short-term basis. There could be long-term debts. These could be bonds issued by commercial banks for longer periods. There could be other liabilities also, like accounts payables or accrued expenses. And the last item is the equity capital, which represents the shareholders' net worth. So this is in summary the balance sheet of a commercial bank. So there are 2 points which need to be emphasized on this slide. Is when individuals and businesses are transacting in an economy, let's say they are buying or selling goods and services, so they often use their debit cards to make payments, or they draw a check, or they make an electronic transfer. So when that happens, the commercial bank's liabilities, so what would happen is this would be affected. So the commercial bank's liabilities, the deposits will be used to settle the transaction. So when a debit card is used, for example, a customer goes to a shop and tries to use the debit card, then it instructs that transaction, instructs the bank to transfer money from the issuer's account to the recipient's account, and then this deposit amount will be adjusted accordingly. Similarly, at a higher level, so this is at the level of individuals and the commercial banks. At the level of the commercial banks and the central bank, for interbank settlements, the mechanism is very similar. So when banks need to settle transactions with each other using the reserves they hold at the central bank, basically they instruct the central bank to make the transfer, and the reserves which are appearing on the liability side of the central bank are used to settle the transactions with the other banks. So commercial banks use liabilities of the central bank to settle the transactions. Similarly, the individuals use the liabilities, the deposits on the liability side, to settle transactions with each other. So this is how the modern money works, and this is how transactions are settled between individuals and the private sector. And this is so between the individuals and the businesses, the settlements are done using the deposits at commercial banks. The settlements between commercial banks are settled using the liabilities, the reserves at the central bank. So that's what we need to remember. This is how the settlements take place at the level of the commercial bank as well as the central bank. Okay, so let's look at the simplified private sector balance sheet, and we are defining private sector in a very specific way. This is the non-banking private sector, so it excludes commercial banks from the analysis. It could be individuals or firm or private companies, but not commercial banks. So when we are talking about private sector in this course, we are talking about non-banking private sector. So let's have a look at the balance sheet. So first we have the asset side, we have deposits. So let's say you have $100 in your current account. So those $100 are asset for you. However, every financial asset has a double entry. So a financial asset, i.e. money in your current account, is an asset for you, but it's a liability for the commercial bank. So it's appearing on the asset side for you, this bank deposit of $100. However, this $100 would appear on the liability side of the commercial bank. Similarly, you have physical cash. Let's say you have notes and coins. These are financial assets. So financial assets, as I mentioned, must have two entries. So financial asset in the form of physical cash, i.e. notes and coins, they are assets for us as individuals. However, they appear as liabilities on the balance sheet of the central bank. So just to remember this fact simply, if you go to a shop and you buy a chocolate and the vendor asks you, sir, would you like to pay by cash or would you like to pay by card? So essentially what the vendor is asking is, sir, would you like to pay using the liabilities of the commercial bank or would you like to pay using the liabilities of the central bank? So if you pay by your debit card, you're actually using your commercial bank liability to pay. However, if you use notes and coins, you are using the liabilities of the central bank to pay. So the decision to use central bank money or commercial bank money is yours when you go to the shop next time. Third, you have bonds. So let's say you buy government bonds. They appear on your asset side. And as usual, any financial asset must have a double entry. So financial asset, i.e. the bond, appears as asset on your balance sheet. However, it appears as liabilities on the government balance sheet. So in addition, we could also have physical assets, including automobiles, property, houses, gold, silver, equipment, etc. And these physical assets would not have a double entry. So unlike financial assets, so 1, 2, and 3 would appear on your balance sheet and also the balance sheet of another entity. So bank deposits would appear in your balance sheet and bank deposits would appear on the liabilities of commercial banks. Cash would appear as a financial asset in your balance sheet. However, it would appear on the liability side of the central bank. Similarly, bonds will have a double entry. It would be an asset for you. However, it would be a liability for the government. So these financial assets will have double entries, would be an asset for one party and it would be a liability for another party. However, physical assets would not appear in somebody else's balance sheet. So if you have a house, it would just appear in your balance sheet. If you have a property, it would be an asset for you, but there will be no corresponding liability in the balance sheet of another entity. So it's a very important concept to understand. So all commodities, gold, silver, house, cars, these are physical assets. These are not financial assets, non-financial assets. They only appear on your balance sheet, not the balance sheet of government, central bank, or commercial bank. So on the liability side, of course, it's the net worth we have. And also we could have loans from commercial banks or other entities. So loans again is a financial asset. So this would have a double entry. So loan, which is a liability in your books, would be recorded as an asset in the books of the commercial bank. So thank you for watching. If you have any questions, please let me know.